Hey everyone, welcome to Dollar Triage, where we discuss personal finances for first responders and healthcare workers, but everyone's welcome. Today we're going to explain markets in memes. It's just going to be an overview of kind of what's what, why it matters, and we're going to try and have some fun doing it. The stuff is insanely dry and boring. If you don't passionately love this stuff, it's just god-awful. So I'm going to try and take some of the pain out for you and explain it in a way that might make a little bit of sense. All right. The real reason most people need to learn this is either one, they want to start investing and don't know kind of the lay of the land, or two, you don't really want to invest that much, but you have your 401k and you need to know kind of how to manage the 401k and make sure that you're not getting screwed over. Because you don't want to leave your retirement to faith or chance that somebody else is taking care of it for you. You want to make sure you're doing it right. So a couple of these topics are critical to being able to, one, retire, and two, start investing on your own. Equities, which are stocks, treasury bonds, index funds, ETFs and mutual funds, debt securities, which are corporate bonds, all this crap we're going to go through. If you identify with these memes, then you're in good company, because I'm definitely with you on both of them, believe it or not. No one knows how the markets work. It's black magic. All right, so what is the stock market? It's Amazon for financial assets. There's two ways these transactions occur. One is if you decide you want to sell something, you go onto the marketplace, you put it up with a picture and a price, and then you wait for a buyer, me, to come along, and I'll buy it from you directly. Amazon gets a cut for their trouble for playing matchmaker, but other than that, it's basically a trade between you and me. The other way stock markets work is that the company itself, the market, or Amazon for our analogy, goes out, buys a bunch of stuff wholesale, and then they turn around and resell it to the public. So sometimes the house is selling it, sometimes they're just matching up, you and me. And that's really it. That's just what the stock market is. It's an auction house. There we go. I'll learn how to work PowerPoint one of these days. So, stocks, what are they? A stock is a, quote, certificate back from when paper was still a thing. And if you had one stock certificate, you had one share of ownership in a company. Now, a company can make however many they want. So if you had 4 shares out of 12 shares, you would probably own a good chunk of the company and might be on the board of directors at that point. If they have, say, 1 million shares and you own 1 share, then you're just like everybody in the stock market for the most part. Just an investor, no one special. So if you have more than 50%, that's a different kind of thing, but we won't worry about that. They may or may not pay a dividend. Dividends are what creates compounding interest. Dividends are not interest. They are actually profits that are paid to you as you are now part owner for having some stock certificates. So it's not interest, but you do get paid the profits, and those profits occur in dividends, and it's a percentage that you're paid based on the number of shares you have. So typically, the more dividends you get, the more stock you can purchase, therefore the more dividends you can get, which is why it compounds. Now, stocks are used for growth. They, quote, participate in the upside, and there's no limit on downside risk. It can go to zero, and it doesn't really need to make sense either way, why it goes up or why it goes down. The stock market acts counterintuitive to all logic. Believe me, I've tried applying logic to the stock market. It never worked once. When March 2020, February 2020 happened, there was a little bit of a crash, but then as everything was shutting down and the world was descending into chaos, the market took off like crazy. And now that things are probably a little bit more common, a little bit more normal, aside from a couple other things in the headlines right now, it's not doing so hot. And there's a lot of other reasons for it, but basically nobody knows the future. No one knows what's going to happen. So I think I just covered that right here, actually. All right, I know my own slideshow. Yay. So yeah, stocks are used for generating profits in your portfolio. They're for growth. So the idea is that you own a part of the company grows, gets profit, and then passes that along to you since you're a shareholder. Anyone that promises returns or profits is being dishonest. I want to throw out a big red flag for you guys. There are a lot of scams on the internet. Probably someday will even be in the comment section in this, where people promise, hey, I gave you $5,000 and I got $15,000 in returns with this trader guy. Go talk to this trader guy. It's a scam. That doesn't happen. No one can promise returns. And if anyone's asking you for money to give you returns, they're going to steal your money. Likewise, you don't really want to listen to the people who kind of have the same talking heads personality on YouTube or the radio or TV, because usually they stick to one theme, whether stock market's going up or it's going to crash. They have their reasons. No one knows why. No one can promise anything. So just watch out for pitfalls with stocks. Now, if you are familiar with stocks, you're probably familiar with bonds, but not too many people understand the intricate workings of bonds, specifically treasury bonds. What a bond is an IOU. It's a loan. Someone's borrowing your money and they're giving you a little bit of interest for the trouble of doing it. So a treasury bond is issued by the United States government, the U.S. Treasury. It's backed by the full faith and credit of the U.S., and it's the only part of the market that is viewed as guaranteed income. It's guaranteed and considered risk-free because if the U.S. government runs out of dollars, they can just make more and will pay you. So it's more or less guaranteed. Whether or not that's the correct thing to do, they'll do it. They've already done it. Bonds hold an important place in retirement portfolios. Usually they're used as income and held in like pension funds and 401ks. So the reason they're used as income is they have a face value, say $1,000, and it has a maturity. So, for example, we'll return you $1,000 in 10 years. And it also has a coupon or an interest rate. So since you gave us $1,000 for 10 years, we'll pay you 1% every year for 10 years. So it's guaranteed to be paid back, and it's going to produce some income. That 1% per year is your profit. And that's guaranteed. Typically it's small amounts, so portfolios need a large quantity of these to produce a meaningful amount of income. And the problem is that the coupon rates with the bonds, the interest rates, since our interest rates are so low right now and have been for a while, they don't keep up with inflation. So if you have a bond that's paying you 1% and inflation 7%, you're losing 6% per year for holding the bond. So that doesn't work in the 60-40 portfolio anymore. The 60-40 portfolio used to work when we had high interest rates, but it's toast right now. And this meme really cracked me up. Yes, our parents used to put 10% of their paychecks into government bonds for savings. That used to be one of the best ways to save money because it was guaranteed and it had a pretty good interest rate. Now, most bonds have interest rates of less than 1%, so we're like, screw it. We're just going to throw all our money into the stock market. See what happens. Okay. The index funds are super important to know about because by and large, they're going to be one of the only things you can buy in a 401k or retirement portfolio that's not self-directed. This is the one that your company or agency sets up for you. And you can probably only select a small number, and they're going to be interesting to go through, but we'll go through that a bit later, probably in another video. So what an index fund is that it tries to track an index, and an index is a collection of stocks. There are various well-known indices, probably in that one, yep, grammar. Like the S&P 500 you may have heard of, that's the top 500 companies in America. The NASDAQ is the top 100 tech companies. The Russell 2000 is 2,000 of the larger growth stocks, the small cap stocks, the small businesses that are becoming big businesses. So that might make a lot of money, but also might fail. Those are small caps. And there are two kinds of index funds. The ETF, or exchange traded fund. And this is basically when a financial company buys up a portfolio of stocks, and it could be 100 or 1,000 stocks, it doesn't really matter. They buy up this portfolio and they create shares to sell to you of their portfolio. So as their portfolio performs, that is how your shares of the ETF perform. And there are some very well-known, very successful, very low-fee ETFs that are fantastic for long-term investing. Specifically, I want to mention anything by Vanguard, most anything by Vanguard. I won't give out specific recommendations here, but you can read all about them on the interwebs for free, and maybe at some point I'll be able to get enough legal compliance stuff together to be able to talk about the individual index funds. But for now, just know that they're passively managed, they're low fees, they can be bought, sold, just traded like stocks regularly on the stock market, and the ETF shares try to track the price of the index closely. On the other hand, there are mutual funds, and mutual funds are definitely featured heavily in investment portfolios for retirement accounts, specifically ones that are issued by employers. They can be passively managed like an ETF, but also they are often actively managed. They have to pay for those active managers, so they have higher fees, and they do try to beat the market. They are not content with having their fund track the index. They want to actually try and outperform it. And generally speaking, that takes an active fund manager to do so. And they trade a little bit differently than an ETF. You can only buy or sell once per day. Not that that matters a whole lot, but we should probably not get into that right now. So, ETFs are passive investing. If you've ever heard of passive investing, you've heard of ETFs. The buy and hold strategy does beat active trading over the long term. Hands down. They say something like 90% of people who actively trade the market cannot outperform an index fund that's an ETF. So mutual funds will pay financial advisors some big bucks in commission. They'll straight up give away like cruises for a prize, like week-long cruises for a prize to whichever whichever financial advisors sell the most mutual fund shares. Like they pay big bucks to get their mutual fund sold, which is why they're going to be heavily featured in your retirement portfolio. So they're going to tell you that a mutual fund is the best thing ever. It's actively managed, it can outperform the market, and they will sell the hell out of these trying to convince you that a mutual fund is the best thing ever. Of course, typically they don't actually beat the market because very few people or products actually do beat the market. And with all the fees coming out of your mutual fund taking your money, you can actually underperform the market pretty significantly. Even if the fund itself does beat the market, you still have those fees taking a chunk out of it. And those fees get pretty spendy pretty quick. Usually can be upwards of 1% even of the money in your mutual fund. So it can take a chunk out of that, especially compounding over time. All right, junk bonds. Debt securities. If you've ever watched The Big Short, you're probably familiar with collateralized mortgage obligations, CMOs, or CDOs, collateralized debt obligations. Debt securities are bonds that are issued by corporations, private issuers, as opposed to, say, a sovereign country. These can be lower risk when a large blue chip company issues debt, like Apple, just for example, not an endorsement or recommendation, but one of these large companies that have been around a long time, have a proven track record, lots of profits, lots of cash. That's a pretty safe bet that if you want to take an IOU from Apple, you're going to get repaid. And so their interest rates are a little bit lower. You can get really high interest rates on corporate bonds. These corporate bonds are really high risk, and usually they're issued by struggling companies because they need to raise cash, right? So a company who's not making money and is desperate to raise cash probably isn't going to stay around too much longer. It's a lot of risk. So in order to compensate for that risk, they offer a much higher coupon rate, a much higher interest rate on their bonds to try and entice you into that. So even if you don't get the principal paid back, the main face value of the IOU, you'll at least hopefully have made some of your money back via the interest, via the coupon rate. If it goes to zero, you get nothing. You get nada. Same with stocks. If your companies that you're invested in goes to zero, there's no like FDIC insurance, for example. There's no guarantee you're going to get anything. The company goes through the bankruptcy process, and the court basically decides which debt holders get paid. Now, stockholders are pretty close to the bottom of that list, and corporate debt holders, like a bondholder, is a bit higher on that list, so there's still a fair amount of risk in all of this. 60/40 portfolio, one of the big things you want to check out in your retirement portfolio is you probably have some bond funds, and you want to see what bonds those funds are invested in directly. Because if you have a 60/40 portfolio and you're like, I'm safe, man, I'm good, I have 40% bonds, this market tanks, I'm all set, these things are just about guaranteed, they're as good as cash. Well, you want to dive into those funds and see how much corporate debt they're holding and of what credit rating they are. You want to make sure that you're holding mostly treasury bonds, government bonds, because those are guaranteed even if they're lower interest. But I've seen a lot of 401k funds that have really high yield junk bonds making up 50, 60, 70% of their the bond ETF or the bond mutual fund that they're invested in. So if the housing crisis goes bust, or if the housing market goes bust, or there's a big financial crisis again and a bunch of companies go bust, that's going to take down a lot of those junk bonds. They're going to go to zero. And so a lot of your portfolio, the part that's supposed to be guaranteed and safe, can actually go to zero. So that's something you want to make sure you watch out for. All right, that'll about do it. Thanks for watching. Please drop any questions you have in the comments. Let me know in the comments what you'd like to learn about next. And that's it. Thanks so much.